Hey everybody, Lehman Brothers was a massive shadow bank that failed in 2008, and when it went bankrupt, that's when things really went to shit. So we're going to look at their balance sheet right before they failed, and a balance sheet is a snapshot of a business's financial health at a given point. So you see why it would be logical to look at this. So as an analogy, let's pretend that Lehman Brothers bought a house for $691,000. To buy that house, they put 3% down, which is their equity, and they took out the remaining 97% as a mortgage, as a loan. And that's what a balance sheet is. Both sides have to balance. Your down payment plus your loan has to equal the purchase price. So the question is, if you only put 3% down, what happens if there's a 4% drop? Because the amount on the mortgage isn't going to change. You go bankrupt. And if your liabilities are greater than your assets, that is literally the definition of bankruptcy. You may be suspected, but we've been using real data the entire time. So Lehman Brothers at the end of 2007 had $691 billion worth of stuff. They owed $669 billion against it, and their down payment or their equity was only $22 billion. So effectively, they had no buffer for turbulent times. If you have any feedback, I would love to hear it. Email me here and I will definitely get back to you. Thank you.